So good morning, everybody. Coronavirus is continuing its grip on the world, as we all know. In the UK, we've had 120,000 tested positive, but some good news this morning with the death rates being a little lower. And of course, recently, the Office for Budget Responsibility warned of a 35% fall in UK GDP, possible 2 million job losses. Things are, of course, considerably worse across the pond. Areas of the world are getting better. Some evidence of new spikes in Asia. Lodders is also part of a UK group of accountants and lawyers called the UK 200, and the member firms recently polled clients, and based on 1,600 responses, 30% of SMEs felt they were at risk of not surviving this pandemic. So what can we do? Well, the government has set up a number of support measures. And what we wanted to do really is to set up a discussion forum for business owners to be able to raise questions, but also share experiences about what was working well for them and challenges they have been having. We're going to kick off the first of our 3 sessions with a furlough update, and of course the portal is opening today. That will be led by Faye Reynolds. Faye is an employment specialist at Lodders with 10 years experience. Then we're going to have a session on loans and cash flow management ideas, which will be led by Colin Strevens of FRP Advisory. And Colin's been advising businesses large and small in various financial capacities for 15 years. And then we're going to have a look at what's happening in the public markets, and that will be led by Anthony Ward of Blackstone FM, who has been advising clients on wealth management ideas for nearly 25 years. So with that intro, I'm going to pass over to Faye, who's going to talk about the latest developments on the furlough side.
Okay, so this first slide is just a general reminder of the coronavirus job retention scheme, which is more commonly referred to as the furlough scheme. I'm assuming that by now most people that are on this webinar have a good grasp of these very common points of what furloughing is. So I'm not going to actually run through those points because they're quite self-explanatory. Given the limited time, I'm going to move on to my next slide. Okay, so this is an overview of who can be furloughed. And the point that I wanted to make on here really was that there has been some misconceptions that it's only employees. It's not only employees, it's also workers that are on the PAYE scheme. Registered, that's the important part, that they were registered on HMRC's real-time information for PAYE on the 19th of March 2020. Now, that date obviously is quite new and is good news for a lot of people. That was amended on the 15th of April from the previous date that we were working to, which had been the 28th of February. So that's extended that date somewhat. Now, the reason that I say it's important that people are aware that it's not just employees, but that it's PAYE workers is because it includes the following people that can be furloughed, and that is office holders and company directors, salaried members of limited liability partnerships, agency workers, and that does include 0-hour workers and those that are employed under umbrella companies, again, as long as they're on the PAYE system. LIMBY workers, which are your gig economy, so your Deliveroos, people like that. Shielding employees, and I can talk about that later in Q&As if needed, and employees with caring responsibilities. Now, as we know, just a very quick point on that, employees can request to be furloughed, but the employer doesn't have to furlough people. When somebody is furloughed, it's very important to be really aware of what somebody cannot do on furlough. And that is, so this sentence is really crucial. They cannot provide any services or generate any revenue for their employer. And there's a lot of prediction that in the future HMRC will be paying quite close attendance to what those on furloughed have been doing. So I think if you've got staff that you're furloughing, keep that sentence in mind. If they're going to do anything for you, keep it in mind that they cannot provide any services or generate any revenue for you. But what they can do, and some of these have caveats, they can do training, they can volunteer, and they can work for another employer. If they're going to work for another employer, so they could be furloughed by you and they could go and get a job with another employer, maybe work in a supermarket. I would suggest that you ask your staff to be upfront with you and tell you, and that you make sure that they're not going to work for a competitor. That wouldn't be helpful for you. And I would also severely restrict any other activities. What we don't want people to do is to go off and do things that they believe would be harming your company, but actually HMRC may interpret as them providing services or generating revenue, because we could end up with whistleblowing cases in the future on this. Again, I can deal with that in Q&As. I'm just conscious of my time for my slides. Okay, so some common questions that we've had coming through are the following. So do furloughed workers have to be paid national minimum wage? No, they don't. HMRC and the government are very clear on this. They do not need to be paid the national minimum wage. And the basic reason is because it's deemed that they are not actually working when they're on furlough. Can employees be off sick when they're furloughed? There's actually been an update over the weekend, and I'm aware that the guidance online for employees, not for employers, I think, has just been updated. It's very clear that if somebody is on statutory sick pay, they cannot also be furloughed. But if somebody is not on statutory sick pay, then they can be furloughed if they're sick. So, but a little bit odd, but that's how the guidance is saying. So annual leave, yes, annual leave will continue to accrue as normal while somebody is on furlough leave. Can they carry it over? So yes, the government has provided provision that if people are unable to take their annual leave, that they will be able to carry over 4 weeks worth. So not the UK limit of 5.2 weeks, but the European 4 weeks worth can be carried over for the next 2 years if employees or workers have been unable to take their annual leave due to coronavirus. And again, there's quite a lot of discussion amongst lawyers about what does it mean if somebody has or hasn't been unable to take their annual leave. And again, I'm happy to take questions on that. There's now clarity that if employees or workers have been TUPE'd, that they can be furloughed. The guidance on that is still referring to the 28th of February. So for certainty, stay with that date for now. But I would assume that legislation will catch up and move that date forward to the 19th of March, as it has done with the other main date. But for now, it hasn't done. So just stay with that date for TUPE. We're also having lots of questions on whether those employed by personal service companies can claim for pay and dividends. The legislation is clear that yes, they can claim for pay if they are furloughed, but they cannot claim for dividends at all if they're furloughed. Okay, so there are some softer and some harder issues that I think need to be thought about regarding furlough leave. And one of the main ones is keeping in contact with your staff that are on furlough. What you don't want them to do is to feel isolated or alienated from the rest of the business. So I know, for example, people have been keeping in contact with WhatsApp, Zoom. Some places have been having quizzes to try and keep that engagement up. You also need to think about and all members of staff that are still working but on a pay cut. How do you manage the dynamics of that, of people's thought processes about that, that can be quite a fine balance for you to think about how to deal with. And also, I think you need to be aware that those people that have been furloughed, you may not in your mind be thinking anywhere near that they're going to be made redundant, but they may be very concerned themselves that being furloughed equates to them ultimately being made redundant. So you may need to deal with your staff's insecurities and stresses about that. You need to think about, under furlough, obviously the scheme allows for 80% of salary, with the employer having the ability, if they choose to make it up to 100%. Now, I know some employers are and some employers aren't. What you need to do is to think about, is the business able to make that salary up? Obviously, the portal has opened today. There have been some reports coming in that it's crashed a few times, but others have got through. But you need to think about if you are, able to viably make those salaries up to 100%, because you don't have to. And again, that really interacts with cash flow impact. The furlough scheme is obviously very, very helpful and very needed, but it's taken until today for firms to be able to access that portal. I think HMRC are hoping that the first payments will come out. They were saying the 30th of April, they're now saying the 27th of April. But obviously all of this will have had a major impact on and managing the way back. That's really important. We need to manage an effective way back. We need to get ultimately staff back into work. You need to consider, do you need to make redundancies? Are you going to change the way you work? Do you need as large a premises as you have, or can more people remotely? These are all issues that I'm sure that as business owners and management will be going through your mind, and will need to be picked up nearer the time to the lockdown ending. So there has also been some much needed support for the self-employed. I'm not going to go over these bullet points because they're here on the slides and I'm conscious of my time, but just to suffice to say that there is support for the self-employed, but obviously the contention at the moment is people can't gain access to that money until June, and I know for some that's having a huge impact on their life now. But that slide there does run through the conditions that people have to meet to gain the grant if they're self-employed. And I think the next slide also just finishes off some of the conditions and tells you how to make the claim. So you can't make a claim yet until mid-May. You can't make any claim anyway. But as I say, you'll have these slides, so that information is on there. So as I've already touched upon and Graham touched upon, the portal is now open. It opened at 5:30 a.m. First reimbursements were 30th, but as I've just said, there's been some information over the weekend. They're hoping to pull that forward to the 27th of April. That's my time up for now. I'm sure that lots of you send questions in at us. We will help you as much as we can in answering those. And I'm now just going to pass over to Colin. Thank you.
Thanks for the intro. I don't know how many people have interacted with FRP Advisory before, but effectively we advise people in a financial capacity wherever they are on that corporate life cycle. So if a business is growing and looking to take on some funding, be that debt or equity, we can help support to do that. If a business is reaching maturity, still growing, might want to sell, or might want to acquire a business, or if a business is on that decline curve and needs some support as a big part of our business, that helps on that side as well. I just want to talk through a couple of aspects that people have seen a lot on in the press and on TV recently. So most of you, I suspect, will be familiar with the loan schemes now, and some of you may have already had your own experience with this, so I won't go into detail. The concept of the CBILS schemes were actually announced as part of the budget way back in March, which seems like a lifetime ago now, where Rishi announced 30 billion of support for businesses through the coronavirus pandemic. The main development since then has been the extension of the scheme to include larger businesses. So that's the CLVILS, so businesses over 45 million. And there have been some revisions to the existing scheme with businesses below 45 million in turnover, and I'll come on to some of those revisions shortly. There's also a scheme in place for much larger businesses with good credit ratings that make a material contribution to the UK, but volume-wise, the vast majority of businesses fall into the other two schemes that we just highlighted. I think the average size of the loan written so far under the CBILS scheme is about 180,000. I'm sure we've all seen the headlines and criticisms of the schemes in the last few weeks, and I think everyone would admit the funding just hasn't been reaching businesses quickly enough. I think the banks have come in for a bit of unfair criticism in the early days because they were being told to lend quickly, but there are also set criteria to assess against, which doesn't lend itself to quick decision making, and also allows for variations of interpretation. So, I mean, some of the frontline bankers I was speaking to were desperately fielding calls with only limited information to hand when the scheme was first announced. But there have been some welcome revisions, and I do think the Treasury and the banks are trying to do the right thing here, and the early signs are that it is helping. The last figures we had back end of last week, but there's been over 6,000 loans applications being successful, which is twice the amount reported in the previous week. And now 1 in 5 formal applicants are successful. But that is still low compared to normal. I think banks would typically expect applications that they're provided with to more than 20% of them be successful, especially given this is a government-backed scheme, so there's still a lot more to do on it. And I know the banks are throwing resource. Speaking to a friend over the weekend who works for a high street bank, and they've been drafted in from the large corporate team to effectively just rubber stamp applications for smaller loans. But as I said, I think there's still a longer way to go. The main changes for the scheme are removing personal guarantees requirements for loans less than 250,000, and for those over 250,000, scoping out people's principal residences and a max personal guarantee exposure of 20% of the loss. And some banks aren't taking any PGs at all, which is a bit of a change from when it all first came out. They've also made the assessment of the impact of coronavirus a self-certification assessment rather than the bank having to make detailed inquiries, and banks can go straight to using a CBILS scheme loan rather than having to assess whether a commercial loan would be more supportable by the business. So, if you've got a business that has asset collateral but was experiencing cash flow difficulties, they were being told that they should apply for a commercial loan, obviously not as beneficial as getting a CBILS loan. So there's a number of other schemes that the Treasury's announced, as we've all heard about, and these broadly break down into grant-like schemes, and the main one being the job retention scheme that we've heard about already today. And most of our clients have used this and mothballed in some form or another. And there are also what we're calling the payment deferral schemes, like the automatic ability to defer VAT payments due, which I think now has to be paid by March 21. I think you could put the CBILS scheme in with that bucket too, as a common factor across all of those, is that they're liabilities that need to be paid back at some point in the future. So you've obviously got the grants and rebates, which are helping businesses, but and the deferrals are helping from a cash flow perspective. But the main point I do want to make on all of this is that businesses should be mindful of the kind of medium-term impact of what we're doing in the short term. And I appreciate we all have to focus on the here and now, and things are changing daily. But for example, I'm working with a vehicle leasing business at the moment, and they'll most likely be able to get through the next few months with the use of the furlough scheme, deferring VAT and deferring some supplier payments. But the other side of all this, those payments still need to be made. And in particular, they've got some chunky VAT payments and funder deferrals that they've taken on. So we're working with them to assess what their funding options are in the medium term. I think the funding requirement could be exacerbated by a potential lag in trading getting back to normal. I think the general consensus is the longer that businesses are mothballed for, the longer obviously it takes them to come out of hibernation, which means there could be pinch points for businesses in the next 12 to 18 months. And this is where the CBILS scheme might come in, as it does give the option to have capital holidays to match the kind of ups and downs of future trading over the next few months. We've come across a number of other methods that people are using. I'm sure people on this call have got other ideas, and I'm not a tax expert, but we have heard of businesses looking to extend their accounting periods to capture some of the losses that are being made currently, which has a real kind of cash flow benefit of the business, because it should reduce your corporation tax bill for the period in question. And just generally, we're having a number of conversations with landlords and funders of businesses, so HP funders, obviously big kind of creditors of businesses, and we're having some success in negotiating deferrals of payments. So, generally, as I'm sure a lot of the business on this call have been doing, if you've got liabilities and people asking for payment, you should be able to agree some deferrals, which should help you in the next few months. So that's a bit of a whistle stop on all that. I appreciate there's a lot of it in the press already. Be interesting to share any experiences with the loan schemes and things at the end of this call. But I'd just like to pass on now to Anthony Ward, who's got some interesting charts to show us.
Good morning, everybody. I'm sure we can all agree that quite a lot has been happening in the markets, certainly globally and certainly in the UK since COVID-19 really took hold in what seems an age away now. And the next chart, I think, does provide some perspective in terms of our own market, the FTSE 100. This is not the only market. In fact, other markets, such as the mid-cap markets, have been hit more severely. But what we are dealing with here is a global collapse in economic activity that has not been seen for generations. But I would also like to point out, and it's worth noting, that markets have seen some recovery from their low points. Indeed, Vanguard, who you may all have heard of, putting out presenting last week, saying that basically markets have recovered a third of their losses as of the middle of last week. But that does not mean to say we have seen the worst of it or that we're beyond it. But it's also worth noting that whilst markets have taken a hit in terms of the equity market, certain asset sectors such as government securities and of course gold have in fact risen, as one could imagine. What we've effectively got, though, is that people who've made lots of gains in the last few years have seen those given up. But also, it wasn't just COVID that caused such a shock to the market. We may also want to remember the Saudi and Russian oil price war that they created almost simultaneously that was certainly not helpful. I was reminded of this quote a few days after stock market started to crash. And whilst we, from our clients, are not seeing any desperate sellers, we are seeing some modest buying by clients, but I stress the word modest. But there doesn't seem to be a great deal of panic out there from the private investors, certainly in my experience. And I'd like to, possibly the reason for that might be demonstrated in the next slide, where, as you can see here, you can imagine lots of this research is now trolleyed out by various outfits, but we can there's a reason why an awful lot of people don't panic, but there's also a reason why it's not worth panicking. Basically because 6 of the 10 best days to be actually invested actually occurred within a few weeks or a few days of the actual worst days. And this can be borne out certainly from recent memory, if we take the global financial crisis, and going back further than that, the tech bubble, and then also the 1987 stock market crash as well. But it is worth noting that, often people forget that we are seeing quite attractive buying opportunities, and certainly some big institutions and large investors around the world are seeing that it really is such an opportunity at the moment. And why we stress to people it's not the right thing to panic is, again, that if we take lessons learned from the global financial crisis back in 08 and 09, those clients who chose to liquidate at the low points and think it was better to sit out the market suffered ultimately in their returns compared to those who stayed invested. And it is really not an overemphasis here, but it really is not the time to panic, certainly for clients who are investing, because most people are investing not just for the next 3 months, 6 months, 12 months, but they are investing for the medium to longer term. And it would be fair to say that many people have encountered such events as this before. This is a shock to the system. There is no two means about it. It is more of a structural shock to the system, similar to a war or another shock event. It is not a structural thing in terms of the economies, but it really is a shock to the system that has created lack of confidence, and as I've said before, a total collapse virtually in global economic activity, which is meaning we are going to be in recession, and GDP, both here and across the world, will suffer greatly. But there is optimism that by the concerted actions of the governments, that we will see a return to growth sooner rather than later. But that very much depends on how the governments manage over the next few weeks and months, as I'm sure we can appreciate. It is key that people don't panic. They take advice from their advisors, because it is really only going to exacerbate people's problems were they to panic and to sell out. We've engaged with clients to ask them to view their expenditure plans, and they've quite readily accepted many of them. In fact, many of them have been in touch with us first to accept that their income expenditure and capital expenditure going forward, certainly for the next 6 to 12 months, will be less than they had envisaged, as they basically will not be going on certain holidays or doing certain trips, or effectively, some of them in terms of socializing or going out, or events or hobbies they enjoy, they just won't be happening. So people will actually be, we think, preserving some money where they are in a position to do so. Whether we've seen an end to the market falls remains to be seen. Many people, particularly large American investment institutions, called the bottom of the market a few weeks ago. Now, only time will tell if that is true. What may well happen is the bottom of the market levels that we saw may be revisited again depending on the reaction from investors. But we should take a view and hopefully learn from history that the bear market that we're actually in at the moment tend to last for less time than the bull markets or the growth markets. And of course, we were coming off an unprecedented period of growth in terms of equity markets, particularly in America, record bull market, and clients over the medium to long term have still got profits to sit on, thankfully. But as you say, the concerted view seems to be that bear markets, and particularly this one, will hopefully come to pass in a shorter period than is envisaged at the moment. Markets do recover. Nobody actually knows when. And the truth is that when the economy actually does recover, the markets will be ahead of it. Because markets tend to price in. I mean, let's face it, markets have already priced in the falling GDP, both here and abroad. That's already priced in, and they are now looking towards what are the exit strategies and what are the plans going forward that governments can put into place and implement and bring growth back onto everybody's horizon.